Stock splits sound exciting, more shares, lower price, but do they actually change anything? And what about reverse splits? Are they always a red flag? Today, we're cutting through the hype to explain what stock splits really mean for investors. Spoiler, it's not about how many shares you own, it's about what they're actually worth. Stick around until the end, where we'll share how to evaluate a split the smart way.
So, all right, Gary, educational topic, thing number 6. We're talking understanding stock splits. Let's break it down, Gary. I'm going to start. What are they? I'll ask you when they occur. What's a reverse split? But let's just first start. What is a stock split, Gary?
So a stock split, it's a corporate action where the number of outstanding shares is changed. It does not affect the total market value of the company. So in a regular traditional stock split, the most common would be a 2-for-1 stock split. After the split, you will own twice as many shares as you did the day before. And it is typically done to make the stock more affordable for people who might not be in a position to buy a whole share of stock for their portfolio. So, in recent years, we've seen companies like Amazon, Apple, Nvidia, companies that, have multi-trillion-dollar market caps. When their stock prices go up to a certain level, $1,000, $2,000, $3,000, you know, people will often be in a position where, hey, wait a minute, I can't afford one share of stock. They might have, a few $100s to allocate to a position in that company, but just to buy one share may be too expensive for them. So by splitting their stock, they increase the number of shares outstanding. That will decrease the price per share, and they make the stock more accessible to people who, can then afford to buy a single share or a couple few shares, depending. Now, a stock split does not need to be 2-for-1. I've seen them 5-for-1, 10-for-1. It doesn't really matter. It's just 2-for-1 is common, but we've seen pretty much every other permutation.
Gary, what are some things that investors? It sounds like it makes stocks more accessible to a wider audience, right? What are some things that they might need to be aware of, though, or at least some things that might be misleading?
Well, so one thing is people will often say, "Oh, well, great, I have more shares, I have more value." No, you don't. I have more shares, I have a different percentage of the company. No, you don't. You own the same percentage of the same company that is worth the same amount. It's just being expressed differently. The best analogy that I can give you is it's like having a pizza. You have a pizza. If you don't cut it, you have one pizza. If you cut it, once, you have two halves of a pizza. Cut it 4 times, you have 4/4 of a pizza. You still have one pizza. No matter how many times you cut it, no matter how many slices you have, it all adds up to one pizza. That's really what happens in a stock split. It doesn't really have any meaningful impact other than making the stock more accessible to a large number of people.
Gary, let's talk about reverse split, right? So you hear reverse split quite a lot out in the market. What does that mean for beginner and intermediate investors that are curious?
So in a reverse split, it's the exact opposite of a regular split where the number of shares is reduced. And so it could be 2-for-1, it could be 10-for-1. But let's say you have a reverse split, it's a 10-for-1 reverse split. You own 10 shares, and following the split, you would own one share. Now, you still own the same percentage of the company. The value that you own is still the same. But instead of, 10 shares trading at a very small number, you would own one share trading at a larger number.
Gary, we're going to close with some misconceptions, right? So stock splits have a lot of misconceptions. I think we have 3 main ones. So Gary, we're going to talk about the 3 misconceptions of stock splits. Tell us what investors, there's that tongue tie we were talking about, right? Yeah. Stock splits. What was the third word that someone
I don't
threw
remember
into the script? I can't remember. But Gary, tell us about these misconceptions that we need to be aware of.
All right. So the first one is a lot of people think a higher or lower share price means the stock is worth more or less. That's not true. If that were true, companies could increase the value of their business by just doing reverse splits and reducing their shares outstanding. Real value comes from the tough work of increasing sales and margins. That's the only way your position will be worth more. A second misconception is a lot of people will say a stock split is bullish, a reverse split is bearish. That's generally not true. The splitting itself doesn't really affect the company, only how investors feel afterwards. Now, the reason I say generally is it is true that companies with rising stock prices tend to do a stock split, and that signals to the market confidence that past growth will continue. They're saying, hey, look, our price has gone up so much. The future looks really good. We're expecting the stock price to continue going up. So, we're going to split the stock. And that does create a certain amount of excitement. It's also worth pointing out that on a reverse split, those are often done because a stock may be trading below a dollar, and certain people are don't trade penny stocks. They won't own stocks that are trading at less than a dollar. Some of the market exchanges have limitations. You need to have a stock price of above a certain number, and so you'll often see reverse stock splits done by companies that haven't done well. Their stock price has gone down by a lot, and they're doing the reverse split to avoid a delisting. But it doesn't really change the value of the company. It's merely the external events, or the company events that's causing the stock split, either the regular stock split or the reverse stock split, rather than the stock split creating the value itself.